Google, guys, googly moogly. This is a company that back when the stock was up here, we did videos saying we wouldn't pay, I don't remember what the exact price was, but I think I said under 100. And I remember several people saying, it'll never go below 100. Oops. Now guys, in 5 years, it's still up 63%. Okay, that's pretty legit. But in the last 1 year, it's down 27%. You just at some point got to say, hey, guys, no company can be amazing forever. No stock price can be amazing forever. These stocks go up based on short-term voting, based on growth potential. But when they finally hit that growth, at some point you got to slow down. You can't grow 20% a year forever. If you did, you'd be larger than the US and then larger than the world economy at some point. It is not feasible. It's just not feasible. What I encourage you to do, so learn a process. That's what we're here for. Learn a process on looking at a stock as buying a piece of a business. Understand what you're buying. Understand the income statement, cash flow statement, balance sheet, so that you can make the smart decision. And when a stock goes down, you would buy more because you understand the company. That's what's key. Look what's going out there right now with banks. I don't understand banks. I cannot tell you if it's a good time or a bad time to own banks. Why? I don't understand how to analyze their financial statements. They're very complicated. It's why probably 2 weeks ago, part of the reason that no analyst had Silicon Valley Bank as a sell probably has a lot to do with that. They don't even understand banks. At some point, you just got to be smart and say, I look at every stock as buying a piece of a business, and every investment is the present value of all future cash flow. That's all we're looking at here. So let's take a look at some of Google's numbers. First off, market cap and enterprise value are basically the same. What does that mean? Essentially, the company has no debt. Net of cash and everything, if you net the cash against the debt, it's all equal. That's awesome. It's very hard for companies with little debt to go out of business. 2, high return on invested capital. Over a 5-year period, 14.4%. Now, you come over here, 55% gross margin and a bottom line margin in the low 20s over the last 1 year and 5-year period. And over the last year, it's been lower, but that's been part of their headwinds. Advertising, as the world's economy starts to get a little jittery, as Apple changes its rules on advertising, it has affected them. They still own the top 2 search engines in the world, Google.com and a site you're on right now, YouTube.com, owned by Google, and it's the number 2 search engine in the world. Imagine that, guys. Imagine how incredible that is, that Google owns the top 2 search engines in the world. Imagine how to monetize that from there. That's what's incredible about Google. All right, so let's take a look at their 8 pillars real quick. Boom. We love these ones. Where the 5-year PE and the 5-year price of free cash flow are the only X's. Now, look at this. They're around the same price, 25 or 26. Just because they're X's, does that mean you shouldn't buy? Well, for one thing, if you belong to our software, I encourage you to make your own pillars and alter your numbers here. You can put up to 12 pillars here, and the combinations literally in the trillions of different combinations you can do. And the reason being is, one of the problems with this pillar, these 2 pillars is, if the company has a high return on invested capital and growth rate, a decent growth rate, you can pay a premium for the company. Tell me who's going to overtake Google right now in search. It's going to be very difficult. Very, very difficult. Even look at TikTok, which is competing with YouTube. They have shorter videos. If you want to learn something like this, you can't listen to it on TikTok in 1 minute. You can't. And now they're talking about banning TikTok here in the US. Imagine that blow to TikTok. So these are the things to consider when you're looking at companies like this. They have great cash flow growth, low debt, shares outstanding. I'm not a huge fan of buying back a ton of shares when the stock was more money. However, I will let it slide on this one. So let's take a look at analyst estimates here. Now, you guys have heard me talk about return on invested capital. What does that mean? You're going to hear a lot of terms and you're like, whoa, this is overwhelming. I don't blame you. I was overwhelmed too. The point is repetition. We have, I think, about 2,100 videos now in our library on YouTube. Go watch them over and over. It'll become part of you. Just keep watching, subscribe. That way you get notifications. But return on invested capital, the higher the return on invested capital, it kind of promotes the fact that they're a moat. If they have a very, like look at Apple, their return on invested capital is like 37%. It means for them to go grow their earnings, they don't have to invest as much money because they get such a high return on the money that's invested in the business, the capital that's invested in the business. It's a very qualitative aspect, even though there's a quantitative aspect to it in the sense it's a number. But we don't know exactly what premium we should pay for 40% return on invested capital versus 15%. Google's around 15%. The market does about 10%. So that 50% difference between 10 and 15, that's sizable. And I would argue that Google has a pretty solid moat because of that. So I would argue you should pay a premium for Google. What's that premium? That's the hard part. We don't know. It all depends on your situation. It all depends on the market. There's so many factors involved. That's the art of investing. So this is what analysts think Google's going to be making over the next 5 years, almost doubling their earnings per share. And it makes sense because they have a high return on invested capital. As they reinvest in other areas of revenue, they can really drive their profit. This is their revenue growth potential. Pretty solid. About a 50% growth over the next 5 years. All right. So earnings per share almost doubling, EPS revenue growing 50%. So it leads us to our next question. What should you pay for Google? So remember, when you're looking at companies, first make sure you understand the business. You can project out what it's going to do or have some sort of range of what it's going to do in the next 10, 20 years, whatever it is. That's what the stock analyzer is for, putting the low, middle, and high estimations. It's going to give you a wide range. And the further you go out in time, if you go 20 years instead of 10, the range is going to be even wider. And you might sit there and say, well, what use is that? Well, we have to start somewhere. Whether we're right or wrong, it's more about the exercise of getting the habit of looking at what we value these companies at. And the goal will be to buy these companies when they're selling below their intrinsic value. What does intrinsic value mean? Essentially the value of the business in a normalized market. Now, I always recommend your middle section should be about where you put the reasonable growth level for the company. All right? That's about where you should have it. The low side is kind of like, listen, if the crap hits the fan, put this, and if they really kill it, put the high numbers. It's going to give you that range. But that's the point. That'll help you understand when the company is drastically undervalued versus drastically overvalued. We just did a video on Tesla the other day, and I made ridiculous assumptions, and the highest price is $100 on my ridiculous assumptions. Ridiculously high assumptions. The stock's currently at 180. Okay, so it tells me, listen, this thing is overpriced. That's the point of it. Now, if you like this, the stock analyzer tool is used 1.3 million times by our users, and they also have all these other tools, but most importantly, this chat community here with thousands of our investors who sit there and take the ease out of investing and the emotional problems that come with investing. In this every single day when markets are down, people are high-fiving, excited because they want to buy companies they love at better prices. So it's $1 a day. We even have a special $7 for 7 days. Go to everythingmoney.com. It's the easy. If I asked you to spend $1 a day and just give it to me, you would do it, not even thinking. This allows you to change your financial future with it. So sign up. Anyhow, let's go to Google and I'll put in my assumptions and then we'll come back and talk about it. All right, guys. So I put in these numbers, low, middle, and high for the next 10 years. Revenue growth. I did 5, 8, and 11%. 11% revenue growth will be hard for a company like Google, but completely within the realm of possibility. It would take Google's revenue 2.8 times higher than what it is today. That's a big feat for such a big company. That would take them to almost $1 trillion in revenue. Okay, that's a lot. That's a lot of revenue, right? And it's going to take some effort to get there. But not out of the realm of I could see Google 10 years from now. I'm like, okay, if this works out and this works out, I could see that. Low side, 5%. Now for profit margin, I went a lot lower. I said, let's say they have competition. Things don't go as planned. 19 to 23. Same with free cash flow. Kept them the same. Now for my PE, they're currently around 20. And I do believe, based on their moat and their return on invested capital, they deserve a premium. The question is how much? I put 16 on the low side, 18 on the high side. And for my annual return, I already beat it up over here. So I'm okay getting a market-based 10%. And on the high side, I want 15%. And somewhere in the middle, I want a 12.5% return for my efforts for a reasonable company that I'm going to own individually, or else I might as well just buy an ETF. So I hit the analyze button. The stock's currently at $93. It's up 2% today. By the way, the stock was down earlier today. That's what's crazy. You're going to get 6 numbers here: low, middle, and high of earnings and free cash flow. If it's all green, do more research, make sure you love it, and start a position. If it's all red, get ready, add it to your watch list, which is a major component of this software. You can add it to the watch list and it'll notify you when it hits your price. I hit the analyze button. Boom. Low price of 75, a high price of 105, middle price of 89. I have it on my watch list at 85. Guys, it's as simple as that. Keep doing it over and over. Everythingmoney.com, $7, 7 days.